Let's begin today's webinar. Thank you all for attending, and I would like to wish you, of course, a very happy 2019. What we are going to do today is to look at what happened, first of all, during 2018 briefly, but of course we are going to look at the key factors that are going to affect the performance during 2019. And of course, we will look at uh, the world's largest economy, the United States, what is happening there with the Federal Reserve and the president and the political situation there, of course, which can be very important for financial markets. Then we will look at the second largest economy, which is the Eurozone. We'll take a look at the euro and what the European Central Bank is doing now that it is ending its asset purchase program, or its version of quantitative easing, basically. And then we will look at Japan, Bank of Japan, and the relation of the yen to risk appetite. UK, of course, the main topic there is Brexit, but also what the Bank of England and how it's going to react to that. Then we'll move on to two important economies, although their currencies are not as much traded as the dollar, the euro, the yen, and maybe the pound, Australia and China. And finally, we'll look at commodities such as crude oil and gold, as well as a summary going forward and the main ideas. So let's start by the key points of 2018, what happened in the Forex market. First of all, we have to say we had a strong US dollar overall. The US dollar strength was outshined only by the Japanese yen. So we had a more than 4% gain for the dollar index, whereas maybe equivalent gains by the yen would be around 2% in excess of that, which are significant gains, but not as much. We see the commodity currencies being the worst. The Aussie, the Loonie, and the Kiwi took a big hit. They had big losses ranging from around 5 to 10%, although in recent days we have seen quite a significant comeback by some of those currencies. The pound did slightly worse than the euro, nothing too really exciting, though we had the Brexit worries that eclipsed Eurozone slowdown fears. So we are watching the screen as well. So the slide that you missed basically was just an outline that what we are going to cover, as well as what were the main highlights for Forex market in 2018. So let's move on to some charts. Here you see the dollar gaining substantial ground against the Canadian dollar, because you see how many Canadian dollars can one US dollar buy. So this is a substantial gain. And this was only rivaled by the losses of the Australian dollar. So we see the US dollar being very strong against both the Loonie and the Aussie. And then we have the yen crosses being particularly, we're showing particular strength, the yen being very strong against both the pound and the euro from the pairs that we are watching, and the dollar losing ground only versus the Japanese yen. So that's an interesting point. So On to the asset performance. What happened to the major assets? What do we mean by assets? Mainly various investments where people are investing. I would say the main theme of 2018 was that there was nowhere to hide. What do I mean by that? All asset classes were in the red, as the next slide is going to show. And first of all, stocks, equities. They were negative shares. They were negative across all regions. Developed and US was doing a little better by falling only 6 to 7%, the major US indices. Emerging markets, Asia on the other hand, their losses were closer to 10%. The German DAX was the worst performer, down 18% on the year. Why was the German DAX the worst performer? I took a brief look into this. Well, the reason car makers are heavily present in the DAX, so you see that there are some worries about the tariffs on European cars, so that hurt the sentiment. We also have a lot of engineering companies, exporting companies in Germany, so those are very cyclical in nature, this business. So this can, when there is not as much confidence, it can contract very rapidly, orders for such equipment, and they have a more global focus and not as much a domestic focus. And of course, German banks, maybe a lot of you have heard about the troubles of Deutsche Bank. So this is another issue that weighed on the German index. Crude oil fell violently. We had surging supply. We have trade wars, worries about a global slowdown. Although we have seen a comeback by oil in recent days again. So what has been happening the past few days has been a bit of a reversal of some of the important themes of late 2018 for sure. And even precious metals lagged. They might have done better as a safe haven, for example, gold, but in conditions where the dollar is strong, gold is not going to do very well. US bond yields, interestingly, soared because of Fed rate hike expectations, but surrendered a lot of the gains late into the year. So the 10-year was up about 25 basis points, the 10-year yield. Bond yields fell, on the other hand, and this is the table that I was talking to you about. So you see all the assets are in the red. Biggest losses were by oil, posting annual losses of almost 20% when we are talking about Brent crude, 25% almost when we are talking about WTI. The smallest losses were perhaps posted by precious metal like gold, and some bonds were not as much. But you see here from the S&P 500, the relatively fewer losses at -6%, all the way to the German DAX, -18%. Here we have soft commodities, copper down 16-17%. So overall, a pretty dismal year for 2018. Now let's look at what the major economies did. GDP growth in the US, we had the Trump tax cuts. This helped growth quite a lot. Now it seems to be reverting back to normal levels as this stimulus is fading. So what is going to happen is growth is for 2018 was around 3%. Now a lot of forecasters are expecting a slowdown to 2.3%. That's still pretty decent, mind you, but still it's a relative slowdown. Inflation picked up overall. Although with oil falling as well, this increase in inflation was contained, and core inflation and personal consumption expenditure inflation still below or around the Fed's 2% target. The unemployment rate fell to 4-decade lows before below, 4%. So that was quite an achievement. Wage growth started to accelerate close to 3%. Nothing too exciting again, but a healthy labor market in the US. So the US economy is in good shape, but markets are not so optimistic, very worried about the recession ahead. Housing sector is slowing, and this investors think that this could be a prelude to a broader slowdown. And of course, housing is very sensitive to interest rates, which have been going up. So you see here the blue line is the National Association of Home Builders Index. The peaks of the index tend to precede the peaks of the S&P. So we had a peak here. We have a peak here. So we'll see. We have to watch what's happening next. This is GDP growth with average hourly earnings. You're seeing wage growth of north of 3% just now, which is very good for consumers. So if the US economy is going to hold up, it's going to be because of consumption mainly. And of course, growth doing relatively well. We also had like more than 4% growth annualized in the second quarter, and we are still waiting for the fourth quarter data, which could be delayed, by the way, because we have this shutdown in the US. It's going to affect some statistics. Now, what happens with the political scene? Well, there was this ceasefire back in October ahead of the midterm elections. There was this ceasefire between the Chinese and the United States concerning trade. So we have negotiations. What is going to happen? This ceasefire means that there were not going to be new tariffs at the beginning of the year, which was a frightening prospect for the market. And we have the markets now moving up and down depending on whether we have positive or negative news from the trade negotiations. We had the midterm elections, and there the Democrats won the House of Representatives. So now we have the Republicans controlling the presidency and the Senate, whereas the Democrats controlling the lower house, the House of Representatives. So there's not much chance of the Democrats and the Republicans coming together. At least we have not seen as much cooperation by the two major parties in the US. So this could lead to some kind of gridlock. And indeed, we have, with the beginning of the year, we have the shutdown, which might be an indication of pretty rough times ahead, or maybe it will be resolved and both sides decides to cooperate a little more. We have staff turnover in the Trump White House. Some very senior figures left, whereas some hawks seem to be gaining Trump's ear more. Now, and this could be a very big question for the US markets. Is Trump going to become a nemesis instead of the darling that he has been so far? Because so far, a lot of investors were liked what President Trump was doing. He delivered tax cuts to them that led to stock market rallying very quite substantially. He was delivering on some deregulation, but now if he's seen as delivering more uncertainty and tension and let's say not providing an environment of stability, that could weigh on investor sentiment. The Federal Reserve, the Fed raised rates 4 times. That was quite a substantial rate hikes by the Fed, by a quarter point. Okay, the rate hikes themselves were not so big. And now, although it signaled 2 more hikes in 2019, the market's not really believing that. They actually believe that there is a chance that we could have a rate cut by this time next year. So that's quite a reversal. The Fed predicting 2 more hikes, markets predicting a rate cut. And Chairman Powell has Fed chair has made it clear that his central bank is willing to pause hikes and even cut rates, so he's going to be more flexible and might even alter the quantitative tightening schedule. So the Fed is slowly shrinking its balance sheet, so that might be tinkered as well if we don't have better news from the economy and the markets. So you can see what the FOMC, this is the committee that sets rates in the Federal Reserve that sets rates, and what the markets are predicting. So there is some divergence. And here you see the dollar index, as we round up the US economy. It has, there was a bit of a top around the 97 mark, so we'll see whether this was a permanent top for the US dollar. Yes, I mean the trend is positive, but this could be a top. On to the Eurozone. There are worries about the Eurozone's economic performance, but growth is seen as holding around 1.5% to 2% next year. There are worries that Germany could also face a slowdown ahead. Headline inflation, well, it's near or above the ECB target, but core inflation, which excludes alcohol, food, fuel, and tobacco, is around 1%. So that's pretty low underlying inflation. Unemployment rate is still falling below 9% right now, so that's good news. But business surveys, confidence surveys, they are showing a slowdown ahead. Still, we have trade uncertainty for the euro area, volatile politics. We have populist movements gaining strength, and a lack of reforms. So this could weigh on. And here is what we were saying. You see the red line is the confidence survey, and it has fallen substantially. It's still holding above 50, which is the expansion contraction border divide, but we have seen quite a deceleration in the business confidence across the Eurozone. Yes, Eurozone GDP also slowing down. So this acceleration that took was in 2017. Now it seems that we are facing deceleration. The QE program by the ECB has ended. It has ended in December. And the end of QE was accompanied by cautious remarks. So what is perhaps striking is that the ECB is very careful not to hike rates too soon and or to tighten policy. We still have super loose monetary policy in the Eurozone. We have negative deposit rates, the refinancing rate very near zero. So, and Draghi and the ECB have pledged that they are not going to raise rates for basically before the autumn of 2019. And we will also get a lot of talk about who is going to replace Draghi. Definitely the ECB is an institution that the chair or its head has a significant influence on policy. It's a very important figure, and definitely we have seen that with Draghi. Politics were not so good also in the Eurozone in 2018 because we had this fight between EU and Italy. Yes, okay, there was a compromise later on. So that crisis seems to have subsided for now. We don't know whether there's going to be a new crisis in the future. we had these protests against the French president, Emmanuel Macron. We have seen quite a lot of disruption into the French economy because of these protests. And also we have the prospect of a no-deal Brexit. We also have the European Parliament elections in May, and a lot of people are afraid that they may bring more populist politicians into the EU Parliament, and that could affect European politics more broadly. So the euro, well, okay. I mean, it was not a good year, especially we had these sharp drops in the in May, and we during the summer there was a bottom around 113, around 113. But since then we haven't really saw more losses by the euro, though the chart is not looking very good. But again, I stress it that we're seeing more or less a range of the euro against the US dollar for the past, I would say, 4 or 5 months. On to Japan, we had some negative news. Third quarter was very negative. Growth was contraction of growth by 2.5%. Growth is expected around 1%, more or less, for this year and the next. So not growing very fast, but at least positive. Inflation, as a coincidence, also around 1%, but nowhere near the 2% target. So we will see what the Bank of Japan is going to say about this. The unemployment rate remained near 2-decade lows, but it hasn't translated into higher wages, and household spending is also lackluster. Exports have cooled, machinery orders also have slumped. So we see that the Japanese economy very very exposed to the global economy, because it's such a major exporter. So if we have a global slowdown, it's going to hit the Japanese economy hard, and this is a theme that I would like to address in a second as well. Now, here is inflation. You see that core inflation even lower than inflation less food, so nowhere near the 2% target. So what can we say about the Bank of Japan? It's stuck with its quantitative easing program. It's the only major central bank still actively buying bonds, and obviously this would be very bad news for the yen unless it was such a safe haven. So we see that sometimes the safe haven qualities of the yen can override the very loose monetary policy that the Bank of Japan is enacting. And we have plans for a consumption tax in October. We'll see whether that goes through, because it has been delayed a couple of times. And this is the chart of the yen. Here I would just draw your attention that the yen was fairly boring, I would say, for the past 3 or even one can say 5 months, but we had this breakdown in dollar yen, and we had a very sharp down move down to the 107, below the 108. Now it's recovered a little bit, it's about 109, but this was a significant development technically. Now on to the UK economy. It's growing at a modest pace. uh, not so bad, not doing as badly, but it's expected to slow less than 1.5%. The growth is going to be less than 1.5%, between 1% and 1.5%. So yes, no big disaster for the UK right now, but it's becoming one of the laggards. Why is this? Well, economists are talking about Brexit uncertainties that have dampened business investment. Obviously, investors want to know what's going to happen with Brexit before they commit more funds, and businesses especially. They want to deal with this uncertainty before they invest. Headline inflation, not really a problem. The labor market is doing very well. Unemployment rate is near four-decade lows. Wage growth has reached a decade high, so that's doing well, which is of course also boosting consumers. And we see that business surveys just above this expansion contraction level of 50 at 51.2, and businesses are starting to get worried about the risk of a no deal Brexit and are starting to plan more actively for that scenario. Here you see growth, you see business investment that has taken a knock. It's down, it's negative right now. Now, what is happening with Brexit? I think it's fair to say that the process remains in limbo. We have a deal between the UK Prime Minister and the other EU leaders, but this is stuck in Parliament, and we have a vote next week, and it's not looking good, the prospects of that particular deal passing through the Parliament. Now, why is the deal not looking good? Well, there is this this issue about the Irish backstop, and it could it could leave the UK in the customs union indefinitely if this arrangement is initiated. So that does not appeal, obviously, to a lot of people who want a clean break from the EU. On the other hand, the Irish question has not been is very difficult to settle. How to leave the European Union while keeping an open border between Northern Ireland and the rest of Ireland, and therefore the EU. Now, if the May's deal is rejected, there could be three options. There would be a no-deal Brexit on the table, of course, which can happen if there's no deal, obviously. We could have a no Brexit, for example, being rolled back, or maybe another second referendum, or through a new election, the Brexit dynamic changing, or a leadership challenge, general election. It could be positive, it could be negative. We'll have to see what happens. And I think that it's fair to say that Sterling looks to be pretty much hostage to Brexit, and that explosive moves could happen both ways. So I think there is substantial upside and downside when we are getting news about what's going to happen with. And until then, I fear that the pound could continue to trade as a function of incoming headlines, and this is going to be very key with politics overshadowing economics, with one caveat, of course. As long as the economics stay in the current, like around where they are now, so growth weak but positive. So now, markets are pricing in a 60% probability for a single 25 basis points rate hike by the Bank of England in 2019. Now, we'll see whether or not the Bank of England is going to hike. It's very uncertain because we don't know what kind of Brexit the UK is going to get. A no-deal Brexit could even see the Bank of England cutting rates. So we could see a complete reversal of that scenario. And all in all, the Bank of England is likely to stay sidelined until the political fog clears. And situation could become clear around March, but it could even become more muddy as we could get like an extension of the deadline, and so the uncertainty would just be prolonged. So we'll see. So this is what is happening with sterling. You see more or less a bad year for sterling, and we had some sharp drops, especially around the middle of December and early January. On to Australia. GDP growth has lost momentum. We have had a drop in commodity prices this year, and this is hurting the Australian economy clearly. But growth is holding above 2%. It's comfortably above 2%, which is a substantial achievement given the global economic environment. Annual inflation has cooled to 1.9% in the third quarter, holding below the RBA target band of 2 to 3%, but still close to the 2 to 3%. A tight labor market, but the Australia wage growth not going up very much, and the Australian dollar was on a downtrend throughout 2018. We have this US-China trade tension, weak commodities, and of course the strong US dollar. So all these things hurting the Aussie a lot. And maybe some of these things are going to stay in place for 2019. We'll talk about that in a second. Now, according to market pricing, the Reserve Bank of Australia is likely to cut rates, more likely to cut rates and raise them in 2019. So, okay, that's also not helping the Aussie very much. The chance that the RBA is looking to cut, although it's not a done deal, you see investors are very reluctant. More or less, I would interpret this as rates holding steady right now. So what happened in China obviously is going to be very important for Australia because it's its largest trading partner, and their domestic economy is of course more important, but it doesn't look like it wants a rate cut for now, although we have a lot of indebtedness in Australia. And we'll see what happens to wages also. That could also be a very important piece of the puzzle. So the RBA likely to wait until wages accelerate. So here you see the wage price index rising between 2 and 2.5%, not nothing not explosive rise. Inflation below 2%. So this is hurting more or less real wage growth, which is minimal. I mean, it's less than 0.5%. So Australian consumers feeling the pinch there, although their wages are rising, so is inflation, so not leaving them a lot of extra dollars to spend. The Aussie, you are seeing this is quite a downturn that it's in, but we have had significant reaction the past few sessions. On to China. China's economic growth has slowed to 6.5% in the third quarter. This is the slowest since 2009. We have some deleveraging going on. We have a lot of debt, obviously, in China. We have uncertainty with regarding the trade war with the US. China exporting a lot to the US. Inflation is stable, around 2.2%. Producer prices also stable, so inflation not a problem in China. The People's Bank of China has cut the reserve requirement ratio, what banks are required to hold with the central bank. So this has freed up liquidity, has boosted lending. The yuan is also under pressure. It's near two-year lows versus the dollar. And Chinese stocks suffered major setbacks during the year on fears of a full-scale trade war. Now, the fiscal stimulus and some infrastructure projects are supporting the economy. We also are reading about new projects that are helping the Chinese economy, so they are preventing this hard landing scenario that a lot of people are worried about. So, what are the risks for China? Of course, the trade war with the US, the fight about intellectual property protection and forced technology transfer. We have to ask what is going to happen if no deal is reached in the current trade negotiations between China and the US. Then we are going to go to fresh tariffs by the US, and this is going to be massive new tariffs. So I think that more or less we're going to double the amount of tariffs that we have right now. So this is going to be a big shock. Now, China has shown a willingness to compromise. The US wants guarantees that it's going to enforce. We do have geopolitical dimensions to this. We have the Chinese Navy showing its strength around the region. The US forces also near there, and this is worrying the US allies in Asia. We see the Shanghai Composite falling by almost a quarter, 24% during 2018, although it has to be said that the Shanghai Composite is a relatively volatile index, and things could have been worse if there was not this substantial stimulus. I would say that the manufacturing confidence has dipped below 50, so this is significant development. Okay, this has happened again during late 2015, early 2016, but this is something to watch. Services, on the other hand, not doing as badly, maybe as a result of the stimulus. Domestic economy is being supported. And this is the Chinese the dollar yuan exchange rate. There was a period that there were fears that this is going to go above 7. For now, these fears have abated because the dollar has been a little bit weaker. On to crude oil. Oil prices rallied to near 4-year highs in October, but they posted very, very steep losses. They hit $42 a barrel. Brent crude briefly fell below $50. Now, of course, WTI is above, was around $50, slightly above 50. So there has been a comeback for crude oil together with stocks. Now, why did this happen? Well, there was a new supply glut. It seemed that more production, more oil into the market. There were worries about global growth. So we saw that oil was one of the worst performing commodities during 2008. We had the OPEC meeting in December between OPEC and non-OPEC producers such as Russia. They decided to cut supply, but this only has the effect of stabilizing prices, and concerns remained about oversupply because US output continued to rise. We have shale oil in the US, which has shale oil production has been rising, and the prospects of a trade war are looking likely to continue to weigh on commodities. So we have to look at we see that if there is optimism about a deal, we see that the commodities such as oil can rally. Analysts are relatively optimistic that oil is going to come back, so they see gains between, I would say, 10 to 20% over the coming quarters. And you see US production. So now I think the US has more or less replaced Saudi Arabia, or close to it, becoming close to the world's largest oil producer at more than 11.5 million barrels a day, 11.6, 11.7. So that's quite a substantial jump of oil production coming from the US. And look at what happened to uh, oil prices. Now, on to gold. It has underperformed. It had underperformed in 2018 because we had the strong dollar. It staged a major rally late into the year because there was this safe haven aspect to gold. So its losses were very modest, closed only 1.5% lower, but still lower. And it's notable that given all these turmoil and volatility, gold did not manage to post a positive performance. So trade fictions did not boost gold as much as expected. Again, we said stock market volatility helped it. We'll see whether gold is going to rally a bit more given rate hike expectations right now are for zero rate hikes next year, by the market at least, and maybe even a cut. So that could really help gold. And of course, gold could be a beneficiary of more problems if should they surface or should they continue in 2019. So here you see what happened to gold. It was flirting with below 1200, but stock market volatility helped it to shoot up to around 1280, 1290, its current level. Now let's sum up on what has happened, and also I would be happy to take any of your questions. If there's something that you want me to address, feel free to put it in the chat box. The US dollar, first of all. Things are not looking terrible for the US economy right now. The US dollar is still the reserve currency of the world, but I believe its upside has been limited by the dovish Fed talk. So before we were talking about how many rate hikes we were going to have next year. Now we are talking about the potential of a rate cut. So despite the US is the best house in a bad neighborhood, it has often been called that. Still, the prospect of even a rate cut by the end of the year is weighing on the dollar in relative terms. The euro is facing its own problems. There is more optimism about the euro currently, but we do have political and economic concerns. It could be a beneficiary of dollar weakness because it's the second, I think it's the second reserve currency of the world, let's say, is the euro. So I think slightly better the prospects for the euro, but still with significant problems. Now, the Japanese yen. I see the Japanese yen benefiting from safe haven flows, although I have to point out that bad news could hurt the Japanese economy especially hard. So yes, we have these safe haven flows, but the Japanese economy if there are bad news in the world, is because of its exporting nature, it is going to have like in the long term it could be very bad for the yen, but in the short term it could strengthen a lot because of its safe haven nature. The pound, well, I will be a little maybe sarcastic about the situation here, but I would say that it's very easy to get the pound right if you can guess right what is going to happen with Brexit. Of course, this is very difficult to guess what is going to happen with Turkey. That's why this is a little bit of a joke, because forecasting what is going to be the end game of Brexit is extremely hard. And given that the pound is hostage to that process, I think the pound is also very difficult to get right. What we can say is that the pound is going to experience a lot of volatility. We have seen, like, very early in the very early days of this year, those sudden spikes down and then up in pound dollar. That was a pretty impressive move in a period when there wasn't really that much going on in terms of fundamental developments. And then the Aussie is I think the prospects for world trade, the prospects for China, and the prospects for commodities not looking too good. So I would risk going out on a limb here and saying that the Aussie would be one of my favorite shorts. So I wouldn't be too keen on the Aussie, given all this uncertainty about the world economy and the possibility of a China slowdown if these trade tensions are not resolved and commodities continue to drop. Now, what about other assets outside Forex, because all the assets are interconnected? So was 2018 for stocks, regarding stocks, was 2018 the year that the 8-year bull market ended and we haven't realized yet? So, stocks have been going up since 2009, and did this bull market end? And we are still trying to figure it out. I think that is a key question, because if this has happened, if this bull market has happened, it's going to have major repercussions for the world economy, for currencies, for bond yields. So I think this is the key question to ask ourselves. And I would say it is looking like this way, because it's very, you cannot have bull markets that go on and on and on. It's a very, very safe bet to say that one year they will end. Now, whether it's going to be 2018, 2019 that we're going to get a bear market, or 2020, we have to see. We don't know exactly when that is going to come, but it's a safe bet that these bull markets, they come to an end. Bond yields, given this uncertainty, they are likely to stay depressed. We see with the Federal Reserve was more or less the only major central bank that was raising rates, steadily. If it pauses, if it stops, I don't see a lot of impetus for bond yields to rise. And finally, commodities. We could have further slowdown and trade fights. They could weigh, and trade tensions. I think that long term there is good value in oil, although it's vulnerable to more selling if there is more bad news about the global economy. It's very hard for oil to rally if we keep getting news that there is a slowdown. On the other hand, gold as a safe haven, especially if the Fed stops hiking rates, I think its prospects are becoming better. So, what trades did we suggest in the previous webinar? USD long, we got it was more or less flat because the dollar had made its gains mostly in the earlier part of the year. Okay, according to one's timing, they could have made money, but they could have also lost money. The euro short did make some money against the dollar because it fell. The pound short, that was a good call because the pound did experience some losses from the 130 level. We saw the pound falling quite a bit. Now, forward looking, I think the dollar is going to be more rangy, so trade more in a range now that the Fed hikes look less likely. But I don't think that the US dollar is going to collapse. So maybe range traders could find the US dollar attractive. And of course, I'm talking about intermediate term. I'm talking like 6 months horizon. So a lot of you, depends on your horizon, on your time horizon that you need to be checking. Now, the pound, I think, is capable of extreme moves in both directions. The consensus in the market right now, I think, is that the UK will eventually find a way out of this mess. That is going to be not, a big disaster. But if the economic or political situations deteriorate, it could drop more. And I think the volatility that we had at the start of the year was pointing to that. I think it is showing us the way for how the pound is going to trade for the remainder of the year. These very, very big up and down moves, or down and up moves, no matter how you want to call it. So I think that we are going to see a lot of volatility there. For the yen, I was personally impressed by how it broke out of its 5-month narrow range versus the US dollar. It looked for months and months that the yen was trading flat and it was very boring. But for me, these gains of the Japanese yen were a confirmation that is still acting as a safe haven. So I think it could be the beneficiary of safe haven trade and safe haven money, and we could see those who are long yen could at some point see rapid appreciation, if particularly, of course, if there is a catalyst of heavy sell-offs, a lot of volatility in stocks, etc. Like I said, I will be very happy to take any questions, and please visit our website, our research homepage at xm.com/research, and also become a subscriber to our YouTube channel where we are posting our videos. Thank you very, very much, and I will be happy to take any questions. Okay, one currency that we did not talk about a lot was the Canadian dollar. We also had the Bank of Canada meeting. That is also a fairly exciting currency to trade, because we see it as being very closely tied to the price of oil. And the situation in Canada, well, it's not looking like on the one hand, the Bank of Canada might be following a little bit the Fed's lead in not hiking rates. If the Fed stops, this could also have impact on that. It's also had the effect of some trade tensions. So it's overall an interesting currency to be mindful of. Also, I would say the emerging market currencies, which we haven't talked about, are very interesting. For example, it was a very, very volatile year for the Turkish lira, as I know that some of you have been watching it. So this was it's very interesting going forward how emerging market currencies are going to react, given that the Fed is not going to be raising, might not be raising rates more right now, but the global economy could be weakening, and the emerging markets are uh, very closely tied to the global economy. Okay, 1 second. For the Aussie, I would say I am generally bearish the Aussie for the reasons that I gave you. That because first of all, technically the Aussie is in a downtrend. So yes, it has reacted quite a bit to. We have seen quite a reversal of the Aussie in the past few sessions, but I am not sure that we have reached the bottom yet. Of course, with every trade, you have to put your stop losses. You have to do your risk management very, very carefully. But given this uncertain environment in the world, and especially this trouble with between the U.S. and China, unfortunately, I don't see this theme of this tension between the U.S. and China ending soon. There could be a ceasefire, but I'm not sure whether this is going to be a tension that is going to be resolved quickly. If it is, great. I mean, it's going to be very good for the global economy. Maybe we will have more gains. Maybe stocks might. It could be stimulus for stocks to move a little bit on the upside, but in the medium term, this is going to be. We'll have to learn to live with it. Um, Furthermore. Now, so this is exactly what we were saying because we had a question on the U.S. and China trade tensions on the Australian dollar. I think that we have obviously the bad news between U.S. and China affects the Aussie very negatively because bad news out of this trade fight is going to depress sentiment in China, and China is Australia's biggest customer and a very important part of global economy and global growth. Now, the dollar Swissy for the Swiss franc, I think that the Swiss franc could also make some gains against the US dollar. The Swiss franc, although we haven't seen it being so reactive in 2018, I think that the Swiss franc could be working again as a safe haven. However, we have to be very mindful that the Swiss National Bank is going to try to arrest any appreciation of the Swiss franc. So we could reach points where we have a battle between currency market and the Swiss National Bank. It could be an interesting battle. Now, the US dollar, we said that there was a top in 2018. Yes, there was a top, but I'm not sure it's going to go back into bear mode so quickly in 2019. Why I'm not seeing that? Well, for that to happen, we are going to have to see more aggressive rate cuts. by the Federal Reserve. And we are not at that point yet. Still, the US, with its current interest rate of around 2.5%, is one of the best yielding currencies in the world. So if you compare it to the other central bank, the US is much further advanced in its tightening, its monetary tightening. You compare it with all the other major currencies, their interest rates are near zero, or so this is a cushion for the US dollar. It can take some bad news as it is. However, uh, this margin of safety could become smaller if we see the Fed starting to cut rates. So this is what I said, that the dollar, I believe, is going to behave more in a range for the foreseeable future. Um, Now, for the impact of the U.S.-China trade tension on the euro, it does affect the it does affect the euro also, because Eurozone is more integrated into the global economy. So you see Germany is a major exporter. It exports so much to China and to the rest of the world. So uncertainty around trade makes Europe more of a victim, let's say, of this uncertainty, even though Europe might escape tariffs because they are a US salary. But like Australia is not going to face like tariffs from the United States or anything like that. But the fact that their biggest customer, China, is going to be facing tariffs, then obviously this is negative. Of course, I don't want to give you the impression that this is a done deal, this tension between US and China. We have this March deadline. I think it's in the interest of both countries to have a short-term deal, and this could provide some relief um, for currencies such as the euro, such as the Aussie. We're just talking about the balance of probability. So please let me know if any one of you wants to receive the slides, because I don't want to be sending you things that you don't like. But if you want to receive today's webinar in slides, I will be more than happy to send it to you. And with that, I will conclude today's webinar. Again, if you want the presentation to be emailed to you, I'll be more than happy to send it to you. I will leave the window open for a few more minutes just in case somebody wants to say that they want the slides. Okay, I will also answer a final question about repatriation of Japanese funds back home. Yes, that has been a very strong factor behind the strengthening of the yen in times of trouble. We see the Japanese investors that they have made substantial investments abroad. The repatriation of the funds it provides a major boost to the Japanese yen, and this is indeed a mechanism through which Japanese yen is a safe haven. So thank you very, very much for your attendance today. I hope it was an interesting presentation, and you learned a few things, or at least cleared up some things that you were already aware of. And I hope to see you at the next quarterly webinar. Take care and bye-bye.